Good afternoon, everyone, and welcome along to OpenCorp's Cashflow, Finance and Property COVID-19 Investment Masterclass. We've got an hour of power plus some time for questions for you today. For those of you that don't know me, Michael Beresford is my name. I've been investing personally for 17 years, been helping others invest for a little over 15 years, and I'm one of the four partners in the business here at OpenCorp. OpenCorp takes education very seriously and believes that it's really the foundation behind why our clients are successful, because they understand why they're doing what they're doing. And our clients and people that follow us are looking to us for expertise on how to navigate the investment landscape. And that includes finance. Finance, without doubt, would have to be the most daunting part of the process for anyone that's ever bought a property, own-occupied or investment, in my experience. And I'm here to nut it out today and simplify it for you with Amanda Gleig, who is a mortgage broker extraordinaire. She's a superstar. Our clients love her. And she was actually a client of ours prior to joining the Open Finance team once we launched the finance business. So it's great to have Amanda along today. We're just working out her video settings, but I'm sure we can probably hear her. How are you, Amanda?
I'm great, Michael. Thanks for having me along. It's really great to be here and be a part of this OpenCorp webinar series.
Outstanding. So just to give you, I guess, some background on Amanda and why we've brought her in today. Prior to joining OpenCorp, Amanda used to run a statewide division of a finance provider that had some of the biggest companies in Australia as clients. So to say that she knows her stuff would be an understatement. She's personally helped hundreds of my clients to improve their financial situation. We're going to share some of those success stories with you today, and want to make sure that that you're able to get access to that same kind of expertise today. Just to give you some insight into how in demand she is and what she's been able to do. In the last 2 months, she's lodged $30 million worth of loans. 20 million of those have settled. And just to put that into perspective, if you settle $70 million worth of loans in a 12-month period, that puts you in the top 100 brokers in Australia. So enough with the introduction, but there is no one better to be learning off today. So in terms of what we're going to be going through, really, I guess, key points that people want to know and want to understand. Okay, clearly the finance landscape has been changing significantly over the last 3 years, and even more so in the last 2 months as a result of coronavirus and what that means for us. We'll talk about how to understand and know your situation. Amanda will delve into that, and there are going to be some tips and tricks and practical tools that we will give you to allow you to be able to do that. Okay, so it's not just theory today; it is actually things that you can apply very quickly and very easily to know your situation. With regards to specifically what the impact of COVID-19 is on the lending market. And as I said, those practical tips you can be taking along with how we can help if looking to refinance and looking to improve the cash flow and the kind of wealth effect that those cash flow improvements can have into the future. So I guess without further ado, what's changed of late? Amanda, if we go back 3 years ago, the lending restrictions came in due to rampant investor activity up in Sydney. Over about 12 months ago, they started to relax, post the federal election. We've seen interest rates come down. We've seen improvements to affordability, and now a range of things in the last couple of months with coronavirus. So what are you seeing? What's changed of late, and what's important for borrowers out there to be aware of?
Yeah, thanks, Michael. Look, obviously a lot's changed in the last couple of months. We've had a small issue with COVID-19 that has impacted, lending in a fairly big way. We've got lenders who've had to adapt their whole business models in light of, I guess, these changes. they've had to adapt to staff working from home in their own homes and individual environments. And some lenders have been able to do that better than others. We've got some lenders who are, have staff solely in Australia, which has meant that
Oh, there. Sorry.
video going, have we?
There we go. Yeah, Amanda's in Sydney. I'm in Melbourne, guys. So we just wanted to make sure that the video was working, and we lost the audio temporarily. So sorry to interrupt your train of flow, Amanda. You were saying.
That's all good. So yeah, some lenders are solely based in Australia, so it's been quite easy for them to adapt in this environment. There's been other lenders who've been severely impacted where their call centres or a lot of their processing teams were based overseas. So when Manila went into total lockdown, Philippines had a lot of staff over there, similar in India. Some of those banks have been, majorly impacted, and we're seeing the flow-on effects of that. We've got in other parts of the industry, valuers have really struggled because they haven't been able to get access into homes to value properties. So we've seen them having to adapt to different ways of doing things. We've even got solicitors and people working remotely from their own homes. So it's been, I guess, a challenging environment for everyone. And on top of that, the banks have then had to think about their own policies for lending and how do they actually lend responsibly in the current environment, but with, some kind of understanding that people's circumstances may be temporarily impacted rather than long-term impacted. So definitely a lot for us to understand, to stay on top of. And really, I guess it's been quite challenging for the banks to adapt to that quickly. One of the good things though is that it has forced the lending environment into the 21st century. And we've started to make better use of a lot of the technologies available to us, be that with digital and remote ID verification, being able to use modalities like this and Zoom conferencing and things like that to see clients. So yeah, I think it's proved how agile and adaptable, the banking environment can be when it wants to be. And personally, I very much hope that some of these changes are here to stay because it does make it much easier for clients and much easier for us as brokers to actually look after our clients.
Yeah, no doubt. It's for anyone that's tried to get finance at any point really in the last 10 years. They've banks want to know more and more about your situation. So I always say to my clients, they've really got to strap themselves in for a 4 to 6 week period. That's how long it takes. Loan approvals in 24 hours. Those days are gone. We'll talk about why it's worth persisting with that later on. But for our listeners, what are the things that banks look at? What are the key qualification criteria? And how can our listeners be thinking, yes, this is me and I've got an opportunity to improve my situation? What does that look like?
Yeah, so in terms of criteria at the moment, look, we have got a percentage of the population that has been majorly impacted with COVID and different industries impacted. So industries that are severely impacted by that are your hospitality, tourism, retail, the events industry. So there are certain lenders that have basically said, look, at the moment, we're not, looking to lend to those particular industries, especially mortgage insurers have said, look, at the moment, there's no certainty around income in that space. Similar for casual income earners, where that income's not guaranteed. The bank under responsible lending is really saying at the moment, look, we don't have any certainty around your income. So really people needing to be, incomes and jobs unimpacted or income that they are receiving enough to be able to service their loans. We're looking for clients who've got low loan to value ratios or where the value of their loan is less than 80% of the value of their property. So we can refinance easily without involving mortgage insurance. And looking for clients who are looking for opportunities to save money and to get ahead. That could be consolidating debt, car loans, personal loans, credit cards and things like that. So yeah, plenty of opportunities for clients if they are in a space to take advantage of them right now.
Yeah, great. So clearly, finance is quite unique to everyone's individual situation, and the recommendations that flow on and the possibilities with regards to saving money likewise. But I guess, if you're out there and you're still employed with the same employer, your income's robust. If you haven't reviewed your loans in the last 6 months, definitely worth doing that, especially if you're in Sydney and Melbourne, based on the movement of the market that's been through the most recent growth cycle. You've probably got more equity there than what you realise. And I'd only reinforce that point around the importance of acting now. I've got a client that I'm dealing with. Their refinance was approved. They've been impacted, so they haven't been able to move forward and get their investment property finance just yet. But with the equity approval in place, we've really encouraged them, while the equity's there, while the valuation stacks up, while your approval is in place, do that and do it now, because in 2 or 3 months' time, you might not get the same valuation, you might not have the same amount of equity, and that might be the difference between you moving forward and not. So we go back 3 years, we had tens of clients that wanted to duplicate. Half of those, tens of clients that wanted to duplicate after the lending restrictions came in, half of those had the opportunity to do it 3 months prior, thought it would be fine. And with the changes in servicing calculators, it meant that they weren't able to move forward, and they've been on the sidelines until recently. So we're very big on taking action at OpenCorp. You know that. The landscapes change. If you're thinking you're fitting the profile of someone that can benefit, do it and do it now. We'll be able to give you the opportunity in our post-webinar follow-up to get that engagement and review your situation. In preparation for that, Amanda, you talk about cost of life. I talk about income minus expenses. As long as the income's higher than the expenses, then people are generally going okay. Can you elaborate on knowing cost of life, what that looks like, and what people need to be aware of?
Yeah, I think, one of the biggest things I see in lending is that people don't have an awareness of what it costs to live. And finance is fun for those of us who are involved in it. But for others, it's not so sexy. So something, very, very basically understanding what it costs you to live your life. And I think, when things like COVID happens, forces some people to reflect on, what their expenses truly are. And for others, it's just an amazing opportunity to really realise, where there are opportunities to either save money and get themselves ahead, or potentially to make their cash work harder for them. So cost of life is a concept which is really very simple. It's looking at your income and having an awareness around what comes into your bank account, be it weekly, fortnightly, monthly, depending on when you get paid. So what is that figure that you have basically coming in the door? Then what are those fixed expenses that you can't change? So you need somewhere to live, be that rent or a mortgage. You then have bills, utilities, could be insurances, other things like that, are part and parcel of your fixed expenses. You need to eat. So all of those kinds of things that fall to your fixed expenses that you need to survive, or your cost of living, your cost of life. Within those expenses, there are definitely some opportunities to save. So I've got clients at the moment taking an opportunity to review absolutely everything, be it their electricity prices, their insurances, definitely home loans, car loans, credit cards, anything that can basically put more cash in your pocket and take it away from those banks that are making a lot of money from us. So after you've kind of taken your income, taken away your cost of life or those fixed expenses, maybe transport when we actually can leave our houses and need to get to and from work, you're left with X, and X is literally your disposable income. Some of that money is going to be spent on living and enjoying life, but some of that money is absolutely cash flow that should be directed towards your goals. So your goal could be investing, it could be getting ahead for the future. Everyone's got different goals and different paths that they're on, but really understanding, where are the opportunities to do that. I've had clients talk to me about just how much awareness they've got around their discretionary spending at the moment. Doing a budget from earlier in the year compared to a budget now, and just seeing how much money they usually spend on going out and, all of these extra transport trips, all of the kids' activities and entertainment and things like that, that obviously isn't going on at the moment. But it's an opportunity to just press pause and really understand, what is your cost of life? If you had to continue on a lower cost of life for a while, is that possible? And what are the opportunities to basically, save some money on the things that you can't not spend money on, or where can you put some money in that disposable cash towards investing or, you know, other opportunities that are going to really help you get ahead in life.
Yeah, CAM's really big, and those that have read CAM's book, My 4-Year-Old The Property Investor, will know this very well. CAM's massive, as we all are, on delayed gratification. And it's impossible to know what to delay and how much to delay and how much you can move forward. You know, we talk to people on a daily basis that are looking to get into the market with their first property, and we kind of, you know, we say, you know, what are you putting away per month or per week, whatever it might be. And 90% of them would say, oh, I don't know.
Yeah.
And we try to help them understand that fundamental to getting to their deposit goal is actually knowing what they're putting away and the time frame they're going to get there. And then, like we've got on the slide here, what are the opportunities and where can savings be made? So we've got a great practical tool that we're going to be sharing with people on the webinar after this. Can you just talk through what the cost of life calculator is and how people can use it to benefit them?
Yeah, absolutely. So the tool is basically a very, very simple web-based calculator. It's going to allow people to input all of those figures and really just play with things to see where they stand. So what I suggest to my clients a lot of the time is do one based on your current situation, do one based on a nice to have situation, and then do one based on, you know, where you'd like to be. So you can have an understanding basically on different scenarios, how much cash you could have available or as that disposable income to be working towards your goals. So really simple, web-based, essentially budgeting calculator that really just helps people understand what their cost of life is and where those opportunities might be to save on things or to invest.
Fantastic. So practical tool that'll be coming to you in an email post the webinar. Use it to play around, and I guess that's kind of really the start of a theme we're going to see throughout this webinar with the key points that we're making, and that is the power of proactivity. You know, as humans, it's very easy to you know, kind of let 12 months just pass by. You know. As if it was yesterday, you know, you just think, oh yeah, I did that. We get comfortable and life just kind of moves on. The importance of being proactive and understanding how these you know, financial things change and reviewing loans and looking at budgets. Have you got a pay rise? If you have, has that pay rise been put away into you know, savings or improvement, or has it just been spent? Things like that. So there are amazing tools and benefits which we'll quantify for you as we go through today, that can be achieved by being a little bit proactive and being willing to spend a very small amount of time. It takes a lot less than what you might think, especially if you're using a broker doing the heavy lifting for you to be able to get those benefits. So stay tuned for the calculator. Let's move towards the specific impact of coronavirus now, Amanda, on the lending market. You know, I'm very big on helping people kind of decipher the fact from fiction, or the hype and hysteria that you hear in the media compared to reality. You know, going back a couple of weeks, if you've been watching too much news, you could have been forgiven for thinking that 100% of Australia were going to be unemployed by the weekend. Clearly, that's not the case. You know, there is a small percentage, as you said, of Australians that have been significantly impacted and in hardship. So we want to make sure that we kind of help them understand what's possible as well as helping the vast majority who haven't been impacted significantly to understand what the opportunities are. So I guess what have the banks come out with regards to policies and support for those that might be doing it tough at this point?
Sure. Look, in the first few days that the government announced their policies, my phone rang off the hook of everyone just assuming that they could have a repayment holiday. This is some awesome news, Amanda. I don't have to pay my mortgage for the next 6 months. How do I make that happen? So unfortunately, that's not what the banks have come out to say. Banks are still making money in all of this, but yeah, the government has allowed those that are facing financial hardship or foresee that they could be facing some hardship down the track to press pause on those mortgage repayments. Now, the policy at the moment does depend on the bank, but for most of those lenders, it is a pause on your repayments for initially 3 months with a review and the option to extend that out to 6 months, depending on your circumstances. So that really just means that you're not making a repayment to your loan, but that repayment is capitalizing on top of your loan amount. So if your repayment every month, Michael, was $2,000, at the end of 3 months, you'd have 3 lots of $2,000 added to your mortgage. So you'd owe the bank $6,000 more than when your repayment pause started. Now, for those on interest-only repayments, it's just interest capitalizing. If you have principal and interest repayments, it is the whole principal and interest amount. So really, it's just being aware of what your bank is offering. Some banks are allowing interest-only repayments to be made rather than the full principal and interest repayment. Some banks are just saying it's a repayment pause or nothing. So I guess, you know, having awareness of what that impact is on the end of this is really then allowing clients to make some decisions on what the right decision for them is. Some people have the ability to talk to their bank about reducing their repayments. Banks don't automatically reduce repayments when interest rates drop. So I have been speaking to some clients that are still making minimum repayments on their loans based on when their interest rates were 5% even from a few years ago. So it could be as simple as talking to the bank and getting those minimum repayments adjusted to what the minimum required repayment is every month. It could be as simple as talking to the bank and trying to get some reduced pricing and getting those repayments down in a different way. But if you really are in need of those repayment pauses, then the banks are there to help. Some of those banks are making it very, very simple to apply. Simple as filling in a form online or having a quick conversation, showing that you've been impacted in some way, and then getting an approval. Other banks are taking it a little bit more seriously and really wanting to have detailed and in-depth discussions around the client situation, just helping them understand that at the end of all of this, they're going to end up owing more money than they would have done if they continued to make the repayments. So it's there for clients who really need it, but it's absolutely not a repayment holiday. There's no true repayment holiday where you're not going to owe the bank more money than you did to start with. So you've got to look at it like taking out a personal loan for the bank for the period of time that you're not going to be able to pay your mortgage.
Yeah, and I think it's been great to see the Australian community, you know, and businesses all kind of pulling in the same direction. And I think that's the main takeaway from me is you know, specifically in our space of property, it's a long-term investment. And if you look at, in the example you used, you know, $2,000 per month over 3 months, if you look at the remaining 25 years perhaps on your loan term and how much your repayment would increase to cover that extra $6,000, it's going to be negligible on a month-to-month basis. But what it is doing is providing stability and support under the property market and being very aware of people's homes and their assets, you know, where we don't have the level of distressed sales and so on that we had, for example, through the GFC and other downturns where there wasn't this banding together and government support as well. So I guess the key takeaway for people, you know, really, again, every bank's different, as you said. The action is to talk to your bank or broker. Be proactive, get on the front foot, and understand again what the options are for you.
Yeah, just understanding the options as well. I've seen a couple of questions come through. Different banks have got different policies around what the actual end result is. So it could be that you're able to extend the term of your mortgage by that 3 months or that 6 months, which means at the end of the repayment pause, your repayments continue at the level that they previously were. Okay, other banks are not allowing that term extension, which means that your repayment will go up by the amount that you defer. So it could be that your repayment might go up $200 a month to pay off that $6,000 extra that you owe the bank over time.
Yep. No worries. So get on the front foot. You know, whether it's a positive opportunity or whether it's hardship related to COVID, far better to be on the front foot. Take that action. Talk to your bank or broker. And again, in the email that comes out post webinar, I believe we're going to be actually providing the full list of contact information for each of the banks, where if you are going through hardship and you need to contact them and engage in that discussion, will give you that that full kind of matrix, so so people know exactly where to go to get that help. Yeah.
Absolutely. Yeah.
Cool. So let's. You've covered some of these points already. I think probably the last point there is going to be coming from an investment perspective and future borrowing impact perspective. As you say, early on, there are a lot of people that thought, oh, I'll just, put my feet up for 6 months, I don't have to pay my mortgage. Just like there are a lot of tenants that thought they'd do the same, and even though they were still fully employed, they didn't have to pay their rent. Clearly, people in the last 4 to 6 weeks have adjusted to what the normality is and what's required. But clearly, COVID-19 is going to blow through at some point. The messages are far more positive in the last couple of weeks than what they were at the start, which is great. What does it mean for people in terms of, either owner-occupiers that are thinking about investing for the first time, or existing investors wanting to add to their own portfolio, right? If you are impacted through this COVID-19 scenario, what's the impact on your credit reporting, and what's the likelihood of being able to get borrowing down the track?
Yeah, look, the ABA, Australian Banking Association, has come out and said that there will not be an impact to clients who are under hardship throughout COVID. Now, the caveat to that is that you weren't in arrears when you entered into the hardship agreement, and on the other side of the hardship agreement, that you then don't go into arrears. So you need to be proactive, talking to your bank early, really understanding what your options are, and ensuring that whatever arrangement you reach, you are going to be able to continue to make repayments either on the other side of that or leading up to starting that agreement. So on your credit report, we've been assured that that will not impact either on a credit score or showing up as a true, defaults or arrears or anything that would traditionally be showing up on a credit report. So be you an owner-occupier or an investor, provided when all of this is over and you go back to making your normal repayments, provided you're able to do that without, falling behind, then there should be no impact towards your future borrowing.
Yeah, excellent. And look, something with regards to understanding your options, you've mentioned reducing your minimum monthly repayment a couple of times.
Yeah.
I didn't actually fully comprehend or appreciate exactly what that meant and what the benefits might be when we first talked about it. So I'm sure there are probably some others out there that are in the same boat. Can you maybe just give an example of what that means and how people can benefit that part of understanding their options?
Yeah, absolutely. So one specific example that I've got is I spoke to clients last week who their repayment was set when they took out their loan, I think it was about 3.5 or close to 4 years ago. Now, they hadn't actually reviewed their lending in that time. So their repayment was set every month on, it's about a 4.95 or a 5% interest rate that was active when they took out their loan. So although their interest rate has dropped a number of times over the past, 4.5 years, that minimum repayment had never been adjusted by the bank. So it was a benefit to them. They were obviously paying off a lot more principal every month. So getting further ahead of their loans, and, the benefit is that they're a lot further ahead than they would have otherwise been. But in this example, we worked out they actually didn't need to pause their repayments. We were simply able to adjust their minimum repayment down to the current, say, 3% rate, which they were on with their bank. And that actually bought them about $800, I think it's $890 a month, straight back into their cash flow to be able to, give them a buffer for other expenses that they had going on at the moment. So it's really just making sure that you're only paying the minimum repayment to your bank if you find yourself in a hardship position or you feel that that's a better decision for you. You're happy to continue to make those higher repayments, absolutely, leave it alone, getting yourself further ahead on your lending. But if you need to review it, it's a matter of talking to your bank and just making sure that that direct debit or repayment that you've got it set up is for the minimum required monthly repayment and isn't set on a previous higher repayment that's never been adjusted down.
Yeah, great, awesome. And what about a quick note about redraw?
Yeah,
So
so
for
redraw is
those people that
really
have
important.
redraw, it's really kind of interesting to understand how the bank views redraw versus cash in offset.
And offset, yeah. So redraw and offset often interchangeably used, certainly by clients who some think it's the same thing, and effectively it's very, very different in the way that those things operate. So to keep it simple for everyone, redraw you need to think of as the bank's money. Okay, it's money that's in a loan account that the bank does have the ability to control. Now, in the current climate and lending environment, rates are going down. So we haven't seen banks really need to look at adjusting repayments and things like that. But previously in a rising rate environment, we did see clients that basically banks would freeze their redraw or actually use some of their redraw to catch them up on their repayments. So it definitely, technically, if you're paying that money back into your loan or into your redraw, you need to think of it as paid off the loan and the bank's money as opposed to your savings. If your money is in your offset or in a savings account, then it's your money. You can access that at 30 seconds notice, and the bank doesn't have a say over what you do with that money. So in an instance where you're looking to pause repayments or you're in financial hardship, the bank will actually freeze your redraw if you don't take it out of your account prior to entering that hardship agreement. So really important that if you are looking to enter into hardship, making a decision if you need to access that redraw, getting redraw out of your loans, and potentially thinking about the right structure and setup for you. So your bank or your broker can advise on that, but very important to understand they're two totally different things, and that banks do have the ability to freeze that redraw or refuse you access to that in certain circumstances.
Yeah, excellent. And I'm just noticed while you were talking, we're getting some fantastic questions coming through from our audience. Just so everyone's aware, we will have full Q&A at the end. As with most kind of complex things, it makes sense to kind of keep a consistent flow of information. So we'll continue to move through. We're not ignoring your questions; keep them coming. We'll cover them all off at the end if we don't, in fact, cover it with the material that we'll go through. So again, key takeaway points there. Clearly, assess your redraw scenario. Yeah. Understand all the different options in terms of how you can reduce what you pay if you need to. For the flip side, again, people that are in a strong financial position in terms of job security and income, these record low interest rates are an awesome opportunity to be getting ahead and really, seeing that that principal amount get eaten into if you're trying to pay off your own home more quickly and so on. Your bank and broker can help. Get in touch, be proactive. Little hint, guys, it won't be the last time you see that action point. Talk to your bank or broker as we go. Alrighty, so I guess in terms of what we're going to look at next, it's always helpful, I guess, for people to get some understanding on and quantify what are some of the savings that are possible. So it's pretty logical to say, yep, we got record low interest rates. Clearly, you'd have to be hiding under a rock to know that interest rates haven't come down in the last 12 months several times. I believe it was, and I'm working off memory here, so please correct me, once in October and twice in March. Is that right?
That's right, absolutely.
Yeah. So we've seen 75 basis points total coming off the cash rate in the space of 6 months. So unprecedented, and hence why, we're saying Christmas seems like yesterday, or at least it does to me. A lot's changed since then. So get on the front foot and review that. And exactly that, lazy borrowers equal bank profits, right? So for as long as like your clients that set up their loan 4 years ago and were in repayments at 4.9%, I think you mentioned, that's just the bank doing better because we're not being proactive. Yeah. But if we actually have a look at some of the success stories that you've shared, they're definitely not our clients with the biggest portfolios. We've tried to give a range here, but it was so great to see Adrian and Mary being so happy with what you managed to do for them. That they actually provided this. Which is a fantastic reflection on the kind of impact that your services and your team have been able to assist to them and what it's meant. Tell us a little bit about Adrian and Mary and what you're able to do for them.
Yeah, thanks, Michael. So this is what gets me out of bed in the morning. You know, I absolutely love helping people to get ahead and buying property and facilitating all of that. But it's also being able to save people money and really looking at helping them to get ahead in other ways as well. So Adrian and Mary came to us. They were referred from a close friend, and they hadn't really reviewed their lending probably in a couple of years. So they were these clients that were on higher interest rates. And, you know, they did the wise thing, quite conscious of their spending, had a look at those fixed expenses when they worked out their cost of life, and really thought, look, it's time, let's really check out what we can potentially be saving on our mortgage. So these guys actually came across to me, and what we had a look at, Michael, was they have 3 properties. So they have their own home and they had 2 investment properties. So done quite well for themselves to build that portfolio. But the interest rates that they were paying were still somewhere between low 4 and mid 4%, which in the current environment is a massive opportunity for them to be saving money. So what we did was we had a look at, could we save money with their current lenders, or would it be a better benefit for them to be refinancing and looking at moving those funds elsewhere? So after reviewing everything, we absolutely were able to restructure that for them, and we managed to be saving them about $6,250 over the course of a year, which, you know, for a family like that made a world of difference to them. Probably took them about, I'd say, 4 hours worth of work. By the time they got the information to me, we had a quick chat and a review of their situation and then did all the paperwork at the end. So to be able to save them $6,000 and to know that that's cash straight back in their pocket was an amazing outcome for these guys.
Yeah, awesome. And I think, you know, I'm sure you come up with it every day. You know, when you talk to people about the savings that can be made, like intuitively it kind of makes sense, but it's not necessarily understood, or people think it's going to be a hassle or a lot of hard work. If I didn't say that it was for refinancing, and I said, spend 4 hours of your weekend doing something and I'll write you a check for $6,000, I don't know one person that would say no. Right. So this is the opportunity that we're talking about. You know, everyone's at home. We've got greater flexibility. Technology's there. It's not nearly as difficult as going through a paper file system and having to send documents across. There's some amazing technology now to streamline that and help brokers be able to see the kind of information, you know, where you don't have to go into your internet banking, print it off and then scan a copy to them. That can be streamlined, and some really great outcomes that can be achieved. As you said, Adrian and Mary have got their own property plus a couple of investments. What about Claire and James, who've got a larger portfolio?
Yeah, so Claire and James, another young family who've done incredibly well to get themselves where they've gotten to in their investing. But they came to me again off a referral of a friend, and they had been, unfortunately, for the last couple of years, paying principal and interest on the majority of their investments. Now, those extra repayments had eaten up a lot of their savings buffer, and they were at the point when they got to me that they were thinking potentially one of the only options available to them would be to sell one of those properties to continue to finance the rest of their portfolio. So what we were able to do was just have a bit of a look at restructuring things and putting things into a format where we could absolutely get all of those properties back onto interest-only repayments and allow them to keep all of those properties, which, I mean, they've worked so hard to get to the position that they were in. It was really important that they were able to do that. So shifting those repayments off really high interest rates, they were between 3.5% and just over 5% when we refinanced them, get them down onto those high 2 or low 3% interest rates across their portfolio, and with interest-only repayments, allowed them to save almost $60,000 over the course of a year. So they were ecstatic, Michael, to be able to keep their portfolio and to have $50,000, $60,000 back in their pocket at the end of the year. That's money that's going to make a world of difference to these guys, and just such an incredible result for them.
Yeah, Claire and James, for our viewers, Claire and James are actually long-term clients of mine as well. They've done a fantastic job. And they're definitely a good case study of you know, taking action and being positive and proactive. They were definitely quite nervous when they started their investment journey. They've done nothing but kick goals. But this you know, this wasn't a 2-minute exercise that you just rolled in and saved them some money. We'd been trying over the course of probably 18 months to help reduce some repayments and review things through a range of different brokers. You were able to get the outcome. I know you're fairly modest. I'll pump up your tires, because speaking to Claire, you know, she said it's just changed their life. You know, and that was the conversation last week. So just to put that into perspective, that's not $58,752. That's more like $70,000 to $75,000 in terms of gross income earned, because you'd have to pay tax on that income to actually put $58,700 in your pocket. So real savings, while these numbers are significant, you know, add your tax rate on top of that, and just think about how long it would take you to get a pay rise of that amount to be able to benefit from the cash flow to this extent. So that is an awesome example of what people with larger portfolios can do. And it flies in the face of a lot of advice that's out there in the market, where if you've got large portfolios or you're carrying some existing debt, don't even bother looking at it, because it's going to be too hard given the lending restrictions. Again, a lot's changed in the last 12 months, and this is an example of that. Not everyone has, you know, multiple properties in their portfolio. Talk to us about Caleb and Nancy and how you got them thousands back as well.
Yeah, absolutely. So look, we deal with clients in all sorts of financial positions. So those that just have, you know, their own home or just one investment property, or those that do hold those larger portfolios. So Caleb and Nancy, lovely young couple, you know, existing clients of mine actually. So we'd written the original loan probably just over 12 to 18 months ago. Their existing repayment was based on a 4.5% interest rate. And in reviewing that, we realised quite quickly that we could absolutely refinance them away from the lender that we had to use at the time to a new lender to really take advantage of a low rate and some savings. So the interest savings, or the savings that we were able to achieve for them, was close to $4,000 a year. But also on top of that, we were able to do it with a lender that gave them $4,000 cash back. So $8,000 almost just on the one property, and cash flow back in the client's pocket. So yes, the savings are not quite as significant as Claire and James, but one property, $8,000, still some great and significant savings to be made.
I know a lot of people that are like $6,000 extra in their gross income and a one-off payment of $4,000. So well worth the time spent. Just for people that might be new to the finance landscape, we use terms like cashback fairly frequently. What is a cashback offer? It's basically an incentive to refinance to a particular lender, yeah?
Yeah, absolutely. So the banks from time to time really target different segments. Sometimes they decide that they're looking for purchases and for new business. Other times they determine that they're looking for refinances and to bring existing loans across into their book. So the cashback offers are money for jam, essentially $4,000 in cash or whatever the amount is, deposited straight into your bank account. So again, you're not paying tax on that, don't need to do anything for it. Literally just shows up in your bank account a certain amount of days or months after you've done that refinance.
Yeah, I know if we start to talk kind of more generally around opportunities now, I know one of the questions that I get consistently asked by my clients, I'm sure you get it even more than what I do, because you're in that patch all the time. You know, should I fix? Is variable better? Et cetera, et cetera. What are some of the opportunities around fixed rates? There are some bargain basement fixed rates out there at the moment. Can you maybe just talk to what they are and how they've come about?
Yeah, absolutely. So we're in a really interesting time at the moment. You know, we've got a historically low cash rate of 0.25%, and the RBA has come out and said that effectively that's going to be their floor. You know, they really don't see that dropping below that 0.25%. They don't believe that there'd be any effect on the economy if that was to go to zero or potentially into negative interest rate territory. So part of the stimulus package that the government released, you know, in relation to all this COVID environment, was that they gave the banks $90 billion on a fixed lending facility at that cash rate of 0.25%. So all of the banks have been told to get out there and to lend money to keep the economy running. And what they did with that, they've effectively determined that they're able to lend that money to people for a fixed rate for that 1 year, 2 year, 3 year period to really try and, give people the ability to take advantage of those low fixed interest rates. Now, variable rates haven't dropped. We only saw one bank, which was ANZ, pass on the latest March of that emergency cash rate drop. All the other banks have held their rates and said that in this environment at the moment, they don't see the ability to pass on those rate reductions moving forward. So very, very different environment compared to previously, where we've seen fixed rates maybe be betting against the banks. At the moment, if fixed rates are 0.6, 0.7, in some cases up to 1% lower than a variable rate, potentially, depending on people's circumstances, could be an incredible opportunity to fix and take advantage of those lower rates and really have both some certainty around repayments, but just know that those rates may not be falling anytime soon.
Yeah, I'm happy to share a personal example. Actually, at this point in time, my 5-year interest only period is coming up, and will shift over to principal and interest in August. And with these fixed rates, I was able to, just on this one loan, let alone across the rest of the portfolio, but just on that one loan, save a little over $600 a month by shifting to that fixed rate. And yes, I sacrificed 4 months of interest only, but when you look at the repayment difference, I made it back in 6 weeks. So before I'd even have to pay the second monthly repayment, I'm in front. So we've got an example down there, just in terms of what that kind of thing can look like, and why it's not necessarily is fixed or variable better. Really try to encourage people to understand on a loan by loan basis, what are the terms of the loans that you have, the remaining terms, are any interest only periods about to run their course? Is it going to shift to P&I? And how can you kind of, secure that lower repayment, even a little bit ahead of time, given that, again, we don't know how long this is going to be around. How long will 90 billion last? Probably not that long. Like we said at the start, be on the front foot. Don't think that it'll necessarily be here in July, because it might not. You'd hate to miss it. Clearly, it's making a lot of impact. And again, these savings, this 8,500 in this example, or 700 a month, that's all post-tax money, right? So add 32.5 or 37 or 45% on top of that. No one can complain that there's not wage growth, because there are other ways to put more money in your pocket.
Yeah, for sure. And I think, it's as simple as looking at your home loans as well. But I've got clients I'm talking to at the moment. I've got a client, we're looking at just consolidating 3 of their car loans into their home loan. So again, it's the compound savings on that consumer debt as well. Rolling that in, we're able to save them even more money. So looking for opportunities to not only reduce the home loan, but if there's any other debt that can be consolidated as well.
Yeah, awesome. Well, that's fantastic. Thanks for sharing everything that you have. Hopefully people have taken away that message, that being on the front foot, talking to your bank or broker to understand what's possible for your individual situation is really, really important. As we said at the start, it's not only about saving money. It's about how you can make those savings compound and work for you into the future. So I just want to share, this is not all about numbers and data, but I just want to share some figures with you that will make the kind of savings that we've helped our clients in isolation. You might be thinking they're big numbers and they'd be great. Have a look at this stuff around the benefit of being proactive compared to complacent over a 10 to 15 year period. This is the cash flow required to hold an investment property. This is a property that we sourced for a client in the last few months. Okay, and this is basically how the cash flows with investment property work. Now, I won't walk through this in ridiculous amounts of detail, because numbers aren't everyone's cup of tea. I want you to understand the takeaway, and my team can sit down and go through the specifics with you if you're curious. But when we're looking at effectively the amount of tax that's paid on income when you have no deductions, compared to the rental income and the tax benefits that investment property provide, this is how the cash flows work, right? So let's say that this $560,000 property gets $450 a week in rent, which is probably on the low end, but that's a nice round number. If we look at all of the costs required to hold that property through the year, and again, we've talked about interest rates in the high 2s, low 3%. I've based this on 4%, right? So it's still pretty conservative. We definitely expect that you could get under that today. But when you have a look at interest, assuming you're borrowing equity for deposit and costs, this is not a cash deposit, plus interest on the remaining debt at 4%, 24,280 would be your annual repayments on the combined amount of the loans. All of the other costs that you have to hold the property, rates, insurance, property management, etc., with some buffer built in, mean that you've got to come up with just over $30,000 a year to be able to hold that property. Now, $23,400 of that, the vast majority, is covered by the rent. Okay. In addition to all of these costs that can be tax deducted, there are some others as well, namely depreciation, that when you're smart about what you invest in and help you mitigate risk on maintenance and repairs, mean that you can really dial up those tax deductions to total, in this case, just under $47,000 worth. So in addition to cash flow savings on your loan, when you look at the cash flow required to hold a property, you've got current tax payable without any deductions on $90,000 at around $22,700. That should have read $22,700, not $27,970 on the previous slide. Apologies. When we look at what the taxable income comes down to, which is the $90,000 plus the rent of $23,400 minus the deductions of $46,700 or thereabouts, the taxable income comes down to $66,700. And the amount of tax payable on that reduced taxable income drops dramatically down to $14,562. So the delta there is over $8,000 that can be put back in your pocket purely from tax savings and tax benefits that you can have by having the property. So step number one can be reviewing your finance situation, seeing if you can save some money on your existing loans, but also understanding what your borrowing capacity looks like down the track. Now, we've had some clients that can refinance only. We've had some clients that can't do anything. We've had some clients that can refinance and save money and have improved their borrowing capacity over the last 6 to 12 months that can actually hold a property. And this is the super powerful part. When you look at the costs required to hold the property and you look at the rent that comes in and the tax savings that come in, because you're effectively putting another $32,500 in your pocket from the tenant and from the government, investment properties, even on inflated interest rates at 4% today, pay for themselves. Okay, so if you know your borrowing capacity and you're sitting on the fence, this is a really good reminder to take that action and benefit. If you're able to refinance and save some money, then the chances are that those savings would pay for properties if you had a number of properties in your portfolio, or if your taxable income was starting out lower than $90,000. Okay, so you can have capital growth focused property. Basically, the growth is for free. You're mitigating your risk because the properties are paying for themselves in this low interest rate environment. If numbers aren't your cup of tea, again, tools and tips and tricks that we use to help our clients understand this. Here are some example documents that we put together that help them understand line by line what the deposit and cost requirements. We feed this across to Amanda and her team to understand the borrowing capacities required, and we help them understand the resulting cash flow on a week-to-week basis to be able to hold the property. Okay, so again, really good opportunity. Take advantage of the record low interest rates because that's the opportunity that we have. This is the opportunity over the 10 to 15 year time frame. Let's have a look at the power of compounding. Now, for those of you that aren't aware of what compound growth is, you definitely need to get in touch with our team and request a recording of our typical property insights presentation. It's only something that 1% of Australians understand, but it's true wealth creation. Einstein, I'll talk about Warren Buffett later. Einstein called it the 8th wonder of the world, and this is why. If we look at this property, and let's say that we just get an average growth rate, this is an average growth rate, according to the ABS, of the 8 Australian capital cities over the last 10 years, then this property bought for $560 today, growing at 5.2% year on year on average. In 10 years, the value would grow to just under $930 and just under 1.2 in 15 years from now. Okay. Now, if we just increase that capital growth rate slightly to indicate the power of compounding and the importance of property selection, have a look at how the numbers, again, compound and grow exponentially from there. Basically, we're getting a result in 10 years compared to 15 years based on the reduced rate of compounding. After 15 years, obviously the difference is dramatic. So as we're saying, most properties today, due to the rental yields, the tax benefits, the low interest rates, etc., even on conservative figures, will pay for themselves. Even if there is a slight holding cost for the property, that shouldn't be a deterrent, because by refinancing in the low interest rate environment, you can probably even save yourself the difference and hold the property for free anyway. So again, for those of you that thought that, you know, a $58,000 net saving per annum maybe wasn't worth 4 hours worth of effort, reflect on this 10 years from now and think, well, wouldn't you be glad that you did that? And got into a rhythm where you consistently reviewed your finances and worked out how you could hold additional investments, grow your wealth position and your asset base with no money out of your pocket, just by being proactive. Okay. You can see the difference that's made between over a 10 and a 15-year period, depending on the capital growth rate. Okay. If you're looking to invest, you've been thinking about it for some time, not sure what to buy. How do we get the 8% versus the 5.2%? You need to talk to us, because these are the results that we have achieved. We had to make a submission to ASIC 18 months ago around our track record. When you look at the 5.2% capital growth rate that has been achieved across the capital cities, the total return that we've achieved for our clients is 10.8%. When you take out the net rental return from that, the capital gain's pretty close to 8%. So through our property selection process, which we don't have time to cover today, it's in Cam's book in detail. It's in our property insights and Masterclass webinars. And I covered it off in our last webinar where we featured Andrew Wilson talking about the impact of coronavirus on the economy. This is why we need to be applying a proven process to our property selection. Okay, so not only are we able to help you with expertise to be able to save money and put cash back in your pocket, let's go one step further. Understand the power of compound growth and understand how you can save the money to hold properties that don't pay for themselves, so you get this growth and you're hundreds of thousands or millions of dollars worth better off. Even from a small portfolio, you don't have to have 5 in there, just by understanding the key concept of compound growth. So based on everything that we've been through so far, I'm sure some of you are wondering, well, what are the opportunities for me specifically? You know, what can I do? Should I be investing? Can I refinance, etc.? In the post-webinar communication that has the cost of life calculator, has the hardship contacts for the banks, you'll also have an opportunity to have your situation reviewed based on your cost of life calculator. If you think that you qualify for a refinance, we can have that reviewed. You can also take up the opportunity at no cost and no obligation to sit down with my team, understand compound growth in more detail, understand specifically how it can work for you and whether or not it can help you achieve your goals. And you can understand our property selection process in depth and the service offering that we provide to do everything for you and even de-risk the process so that you don't get any nasty surprises and you can sleep at night knowing confidently it's covered by the experts. So this is something that I shared during our last webinar that I thought would be worth recapping. Should I be investing right now? The answer is here. No, you shouldn't. Right now, if you've got job uncertainty or you've lost your job. If your deposit is a cash deposit and you would need to use every single cent of your cash savings as a deposit and you're not saving a buffer at a reasonable rate, build up a bit of a buffer first because buffers are important. Anyone else that's looking to invest in the short term, we call that flipping, you know, buy a property, improve it maybe, sell it, etc. Property is a long-term investment. We'll see a floor, because we always do, under the affordable end of the market because people just aren't forced to sell, so you don't get a price crash. I've seen a couple of the questions. I'll explain price drops, what that means, and the data that's measured around that in the Q&A in about 5 minutes. But it's why we invest at the affordable end of the market, because it's effectively recession-proof. There is not one property market. We see significant impacts in parts of the market, negligible to no impact in other parts of the market. Hence why, when we have $300 billion worth of government money already, plus this extra stimulus that will continue to come into the market, that will have an inflationary effect. So if you can mitigate your risk now, if you can save some money, if you can hold a property for nothing, but be in the market and positioned for when that recovery comes in the near future with that positive inflationary effect, then that is just going to turbocharge those numbers that we talked about. So if you have job security, the kind of criteria and qualification that Amanda talked about with regards to those that can refinance, you absolutely, pending borrowing capacity, should be looking at investing and growing your portfolio for those reasons. And we'll sit down with you in those strategy sessions and actually look at your individual situation and what's important. I talked about recoveries, and I thought this would be worth sharing. Again, this is one that we showed briefly during the Andrew Wilson webinar a few weeks ago. This shows the performance of house prices over time back to 1970, and overlaid with that, all of the different world events where the general media had a field day and said that the world was going to end and prices were going to crash. Okay, have a look at what happened. I'll point a few out. This one here is the GFC. There was a downturn in the GFC. The median came back. I made 100,000 in 18 months through the GFC because I bought at the affordable end of the market where there wasn't a massive sell-off and those prices weren't affected. People could always still afford to be buying at that cheaper price point. But straight afterwards, significant recovery. Likewise, through here, significant recovery. If we go back to the Asian financial crisis, the writing's quite small. This is the Asian financial crisis here. There was a small dip. It was so small in the grand scheme of things that you can barely see it. Fairly rapid recovery up until September 11. The world was going to end. Look how rapid the recovery was through there. This is exactly what we're talking about. You can ignore history if you want. The recoveries and the extent of those recoveries, like the US stock market relative to the Australian stock market, given the amount of government stimulus they had in their economic system compared to what we had, is chalk and cheese. When you're talking to our team, if you would like a copy of that Andrew Wilson webinar so you can get the full explanation on what I'm talking about here from a renowned property chief economist, just request that from the team. They can send you the link. Okay. The final thing before we head into questions, we always get asked, so we thought we'd include it for you. Where do we see the markets at right now? What does it look at? What does it look like? And where are the opportunities? So this is the snapshot on how we're seeing the four main capital city markets. They're the only ones that we focus on. What we've seen in the last 12 months in Sydney, we saw the median house price recover. So in the couple of years before that, 2017 to 2019, the median came back between 15 and 20% due to the lending restrictions. and the same thing happened in Melbourne before it surged again, given that the affordability to buy at the top end of the market wasn't there. Amanda, I'm sure you saw, the kind of borrowing capacities coming through were still fairly strong at around 600,000 to 700,000, give or take. Not so much, up around 1.5 mil.
Absolutely.
Yeah. So what we saw with the, as we've talked about, with the interest rate reductions, we saw the improved affordability. Borrowing capacities were better, and that's led the median recovery with more properties being purchased above the median house price in the last 12 months in Sydney. Sydney actually brought on an abundant amount of supply through the development and construction boom that they had. As a result, vacancy rates over the last 12 months have been over 3%. That's 50% higher than what it's been in Melbourne and Queensland that have been around 1.8 to 2%. So much tighter rental markets in Melbourne and in Queensland. And we've even seen vacancy rates coming down in Perth as well, as jobs have started to stabilise. There was a rather large exodus due to a relative lack of jobs, exodus of population due to a relative lack of jobs in Perth in recent years. That decrease has stabilised. Job creation is starting to come back. There is an extensive mining pipeline of activity planned for WA that's being rolled out. A mate of mine's just relocated from Perth up to the Pilbara, and that particular mining project is moving ahead flat out, and they've been bringing population into that town to be able to cater for that demand. So very, very slowly coming off a low base, obviously, in WA. But the one thing to focus on with Queensland that I've mentioned there is the high net interstate migration. That's the NIM, high net interstate migration. Over the last 3 years, people moving interstate have been moving away from Sydney and away from Perth due to relative lack of affordability and jobs, moving into Melbourne, and to a greater extent actually moving into Brisbane based on exactly those same factors. So obviously, affordable market in Brisbane hasn't yet seen its growth cycle, which New South Wales and Victoria have seen over the last 5 years, give or take. What do we look to moving forward? We expect that the median house price will come back. It's already started a little bit in Sydney and Melbourne. I've seen some questions. As I said, I'll explain exactly what that means. What's important is that you don't believe the headline in the paper when it says property prices will drop 20%. Don't have a heart attack. It probably doesn't mean that your house is going to lose 20% of its value. I'll explain that shortly. Due to the border control that we've had to put in place as a result of coronavirus, clearly there's going to be a short-term overseas migration impact. I think that will come back, if you ask me to look into my crystal ball, come back pretty significantly when we get through the other side of this. Australia is going to be the envy of a lot of countries. Our government have really stepped up. They took proactive control. The number of cases of coronavirus are minuscule compared to other countries that weren't so proactive, and they're really coming to the table with regards to support, stimulus, and foundational support for the Australian population, I guess, around work with JobKeeper and so forth. We definitely expect that the rental markets will be strong, especially in Melbourne and Brisbane. Reason being is if the vacancy rate is high 1% or 2%, and in economic downturns, we always see rental demand increase. And the reason for that is if the unemployment rises a small amount and people are looking to, would otherwise have been thinking about buying their own home, if they've got any job security, or they're in that column that I said no, shouldn't be investing in property right now, that means buying property as well, then they're not going to be buying, they're going to be renting for longer. So with a restricted rental vacancy rate currently and rental growth, we definitely expect that will occur. And we've already started to see that happening in some pockets of Melbourne. From WA's perspective, I mentioned the mining projects, I mentioned the government investment, a lot of infrastructure projects happening in and around Perth to really set it up for the next 25 years. And as those jobs continue to grow, population growth continues to occur, then that rental market and the unemployment rates will continue to drop. They'll tighten, and Perth will see its way out at some point in the future. It's been obviously quite low for some time. So there's a quick snapshot in terms of how we see the markets in Australia right now. Just before we take questions, the choice is yours, ladies and gents. Take control of your destiny. Warren Buffett is someone that I listen to a lot. He's worth about 90 billion or over 100 billion, I read in Forbes last weekend. So he's clearly done a few things right in his nearly 90 years on the planet. And this is one of his sayings that Alcam, Matt and I love, and our staff hear all the time. Be fearful when others are greedy, and greedy only when others are fearful. No one makes money if you follow the herd and do what everyone else does. You need to understand the fundamentals, be proactive, and take advantage of the opportunities. So here's the fork in the road. I encourage you, don't be fearful and lazy and be missing out on opportunities. Amanda's quantified what those savings can look like, what the process is to go through a refinance, and you can check out that cost of living calculator that we'll be sending out. On the investment side, that means that you can hold properties for free. Don't try and make money in the next 2 weeks. If you take a long-term approach, you can see the benefits in the hundreds of thousands of dollars, and you can really set yourself up, and you'll be able to say to your grandkids one day, well, I did this when no one else was doing it, and look what happened. Okay. Hopefully that's been helpful for everyone. We've been through the downturns. We see the indicators. It's pretty consistent. Lather, rinse, repeat from one downturn to the next. There's always an upside. Take the opportunity here and now to save some money and position yourself for future growth. Anything to add, Amanda, before we take some questions?
No, absolutely. I think just as Michael said, take advantage of now to review, understand your situation, know your cost of life, really look for the opportunities that might be available to you, either to save some money or to be proactively looking for ways to get ahead in this current time. And we're all here to help and assist in any way we can.
Yeah, great. So for anyone that might have been tuning in for an hour-long lunch break, we'll let you jump off now. But again, just a reminder of what will be coming out following this webinar for you is an email from our team. It will have the cost of life calculator in there that you can use for your budgeting. It'll have the list of hardship contacts for all the different banks. It'll have an opportunity to review your situation, share some information with us, and review your situation to see if refinancing is possible. If you know your borrowing capacity and you want to go through a refinance process along with with looking at your individual situation and what might be possible from an investment perspective, there'll be a link there to be able to request a no cost, no obligation strategy session with one of our team. We're taking a long-term approach. There are some discounts in the market that we've been able to get for clients because of the relationships that we've got right now. So over and above everything we've talked about already, if you needed any other incentive, there's an opportunity to buy under market value. Given our clients understand how to take advantage of this, the general market does not. So let's click over to questions. Thanks again for all of the input and for the comments that the information's been really helpful for everyone that's tuned in. That's great, and wrap that we are helping you guys understand the landscape and being able to get ahead from everyone else. Question here from Adrian. This is probably one for you, Amanda. I think you alluded to it, but probably worth a quick recap. Are interest rates as low as they're going to get?
Well, I wish I had a crystal ball that worked every day of the week. Unfortunately, it doesn't. But based on what the RBA have come out and said, in that cash rate of 0.25, where we're sitting at the moment, is what they believe to be their floor. Given that banks are being lent that limited amount of funds, the 90 billion at that 0.25 fixed rate, then look, you could join the dots and think that potentially rates are close to as low, if not as low as we're going to see them for the moment.
Yeah. And I've just been saying to some mates of mine over the last few days as well, like, you know, how good does good need to be? You know, 12 months ago, you were paying, you know, high 3%, 4%. Now you can get something under 3%. Don't get greedy,
Amazing when
just
rates
lock it
dropped
in,
into
right?
the 3%, but let alone 2%. I mean, gosh, loans will start paying for themselves soon.
Yeah, indeed. I remember when it was high 9% pre-GFC. So definitely happy days. Hi, Villa. A question from you. How do banks calculate minimum expenses based on household size when assessing eligibility for a loan? Great question.
Yeah, so look, there's something called HEM, or household expenditure measure, which the banks use as a bit of a baseline or a guide. And they look at that based on a few different factors, and all the banks have got their own formulas, but it looks at your household makeup, so the amount of adults and children in your household. It then looks at your postcode and the standard of living that would be based on that particular postcode, and then your income bracket. So what they're saying is that someone who's earning $50,000 a year probably doesn't have the same lifestyle or expenses or outgoings that a family earning maybe $200,000 a year does. So HEM and the bank's calculation of those minimum expenses does vary from lender to lender, but it's made up of those key things: household makeup, your postcode, and your income bracket. So the impact on that obviously is the more you earn, the more affluent postcode that potentially you live in, the higher those minimum expenses that the bank are going to consider for you and your potential personal circumstances.
Cool. A couple of good questions here from Victor. I think we covered the first one. The second one, how do banks assess commission income at the moment?
Yeah, look, banks are taking a very conservative approach to anything that is a variable income. So there are lenders at the moment who flat out said they will only consider a base salary for servicing. So that means anyone who's earning a bonus or a commission or has some allowances and things in there, a lot of banks will not consider that type of income at the moment. Now, there are always exceptions to that. So certain industries that are entirely unaffected in the current circumstances, banks might be able to look at that. But for those that have a predominantly commission-based salary or bonus or allowances, overtime and things, a lot of banks at the moment are unfortunately saying, look, we have no consistency or reliance on that income, so we're not prepared to offer you a loan on that income right now.
No worries. A couple of questions from Lynn and Sam. Thanks for joining us. We've covered those as we've gone with regards to the mortgage holidays. Those questions were when we were discussing that. Yes, Sam. Yeah, the interest will capitalise as we discussed. Good question, Tom. We must have read your mind. We covered off future lending. Banks. A question here from Z. Are banks less efficient than normal businesses? He was talking about I guess paying interest, and then obviously cash rates versus retail rates. Have you got anything that you can add there? Or maybe around bank stability, perhaps, might be what he's...
Yeah, I mean, I think a bank is a business. It's a profit-making entity. It has shareholders and investors, and it needs to pay a dividend and a return to those people. Probably all of us somewhere within our super hold shares in banks and things like that. So a bank has to obviously make a return on its investment, pay all its staff and shareholders. And so there definitely needs to be a profit margin in there for them some way. So whether there are efficiencies or greater economies of scale that could be taking advantage of, sure. You know, every business has its opportunities, but I think you need to understand all of the compliance and the legalities and all of the other things that go on within the lending environment, and just how much time is taken to deliver lending and products and things like that. So yes, there's a margin there. Whether it's reasonable or not, look, that's something that the ACCC and ASIC and APRA need to investigate, and probably for them to comment on more so than us.
No, no worries. Okay, here's the question around: do we expect prices to go up or down, and why? I would love a whiteboard right about now. I'd be able to draw one. However, work with me here. So What's important when you hear headlines and so on around property prices will drop by X. Remember, number one, there's not a crystal ball. Number two, the media are there to sell advertising and headlines and clicks and papers. Thirdly, understand the data that is being talked about. The only metric that is measured around house prices is the median house price. Now, the median is not the average, okay? So if you're reading an article and it says, you know, the average house price in Melbourne has done X, click onto something else because they don't know what they're talking about. The average is not measured. The median is the middle value in a range of sales. And if the median goes up by 10% or down by 10%, it doesn't mean that every property has gone up or down by that amount. It's purely an indicator of where the middle value is. So the reason why in downturns, prices crash, according to the general media, is because the median house price comes backwards. Now, in periods of uncertainty, more properties due to affordability and risk get bought under the median. So say, you know, 600,000, give or take, for example, compared to properties above the median at say 1.5 million, give or take. So naturally, with more sales below the middle value than there are above the middle value, that middle value has to come backwards to recalibrate the middle amount. Likewise, when the market is flying and everyone's happily, you know, confidently buying property, especially at the top end of the market, and that's again the confidence in the market that Andrew Wilson was talking about. It doesn't mean that every property goes up by that amount. It just means that the middle value recalibrates upwards based on the higher volume of sales above the median. So at all times, you've got to have the same number of sales above and below the median house price. So it's just an indicator of where the markets are moving. Okay, so we've been saying to clients a lot, you understand over the next 6 to 12 months and beyond why we invest in the strategy that we do. You only see price drops or market crashes, as the media call it, when there is more supply than what there is demand. Prices go up when there's more demand than what there is supply. Okay, think about bananas and Cyclone Yazi. Banana crops run out of stock, prices go from $4 to $16 a kilo. Pretty basic stuff. So if we don't have properties on the market, we've seen sales volumes come right down. Clearance rates are still pretty good in terms of what's selling. Okay, but the sales volume is just down. So what the government stimulus has done and what JobKeeper has allowed is a floor to be set under the market, because if people have still got that income coming in and 90% of Australia as a minimum are still employed and paying rent or paying their mortgage, then we don't have the forced fire sales like we had during the GFC. So there's more risk in the GFC to price drops than what there is today, based on where we're at right now. And in the GFC, the median house price in Melbourne only came back 10%. So hopefully that kind of helps you understand. We don't have a crystal ball, but the reason why we invest where we do is because it's robust in downturns and it takes advantage of upturns. And that's all you ever want your investments to do, regardless of what the investment is: mitigate risk and grow steadily over time. We're not trying to pick a winner and shoot the lights out in the first 2 to 3 weeks. So hopefully that helps. If I had the borrowing capacity right now, I would be buying and taking advantage of the lack of buyers in the market, which means that you can get some discounts, as I said.
So Brent's got a question just in relation to interest continuing to be charged. So said repayments can be reduced or paused, but in this instance, does it mean you're not getting charged interest on your loan, or will you continue to get charged interest rates? You're just not required to make repayments. So Brent, that's absolutely right. You will continue to have interest payable on your loan. You're just not required to make that repayment. So the interest essentially capitalizes or adds onto your loan every month. Your loan is going up every month in the same value of either the interest only repayment or the principal and interest repayment that you'd normally be required to make. And then at the end of that period, your loan is that amount higher than it would have been otherwise. So in the example we used earlier, if you had $2,000 a month repayments, that was principal and interest. If you took a 3-month repayment holiday, at the end of 3 months, you would owe the bank $6,000 more than you would have done at the beginning. So it's not a repayment holiday. Interest is continuing to be charged. You just don't need to make those monthly repayments.
Cool. There's a good question here from Brad. Do banks adjust the variable rate on your loan without you having to contact them when interest rates drop?
Yeah, absolutely. So the banks definitely do that. They'll make an announcement, sometimes within a couple of days of an interest rate reduction. Sometimes it can take them a couple of weeks to put out their, or that particular bank's reduction. And then they set a certain date for that reduction to happen. So generally 2 to 3 weeks after the RBA drops their rates, you should see that reduction passed on to your own variable rate. So no requirement to contact your bank. That should all happen automatically.
Cool. I might take this one. Why is it better to do interest only? It all comes down to holding cost. So again, depending on the type of loan that it is, what your goals are, all those kind of normal caveats around individual scenarios. As we went through in those cash flows, Ash, if you can have interest only repayments, which allows you to hold a property for nothing out of your pocket, compared to if it was a principal and interest loan, that might cost you $150 a week out of your pocket, because the principal part is not tax deductible. It's only the interest that is tax deductible. So effectively, if you can hold a property for nothing versus something costing you $150 a week, then that just means that you can hold more properties, which give you more, you know, of the 250,000 plus difference over a 10 or 15 year period. That's the power of compounding. So really, return on investment, simply put, is how much you make for how much you spend. So if you can spend nothing, have properties holding themselves and achieving all of that, that capital growth, hence why you get into the market when you can and hold for the long term, and keep your investments interest only wherever possible.
Nita has a question. She says she's got some homes she's paying 5 or 6% on, got about $1.5 million worth of lending. And is it possible to get those 2 or 3% investor loans on her particular lending? So yes, Anita, if you are eligible to refinance, the starting rate at the moment for investor interest only loans is around about 2.6, 2.7%. And that would be open to anyone who could qualify with a range of lenders. So definitely possible to get your rates down into that mid 2 to low 3%, provided you meet those criteria we mentioned earlier.
Yeah, cool. So Anita, keep an eye out for the email that I mentioned as well. The opportunity to give us some details and review that scenario is what you need to be looking for. Ash, again, what are my thoughts on using your super to purchase an investment property? That is a great question. I'm not a licensed financial planner, so I can't give individual advice on what people should do. What I will say is that there are financial planners out there that are talking with us around how the ability to extract some super through coronavirus can help build up a deposit. We're looking at bringing a similar session like this with a financial planner to talk about that. So keep an eye out for that, Ash. Buying property within super has some benefits, obviously, with due to leverage and so on. There are some things that you need to consider around cost, interest rate, holding cost, the amount of super being paid in. You need to get some financial advice on that. Can you refinance if you're not working?
Unfortunately not. So bank needs to see that you're employed and you have some income coming in. The only caveat to that would be if you had substantial income coming in from other sources, be it rental income or dividends or a business or something. But no, income is the main criteria to borrow money. So if you're not working, unfortunately, Deborah, we wouldn't be able to assist.
Cool. Upul, good day. Thanks for joining us. Yes, definitely a good opportunity for first home buyer. There are some first home buyer incentives out there. that are worth seeing if you're eligible for as well. But any time that affordability is improved and it's easier for you to get into the market, when you look back in 10 and 15 years time, you'll be glad you took the step for sure. Thanks for the feedback, Syed. Thanks for joining us. Sam's question around the rates that you were talking about were a range of loan types, Amanda?
To probably clarify that, just because I'm not sure at what point that question came through, but yeah, fixed investment rates at the moment, P&I repayments on your own home would be very low 2%, so 2.09, 2.19. Fixed investment rates, principal and interest, maybe 2.29, 2.49, and fixed investment interest only around about 2.6 to 2.7. So yes, those were the rates that we were talking about, low to mid 2% for almost all scenarios at the moment. Yeah,
no worries. I think we covered the big news question there with regards to where we're not able to help is where income's not demonstrated or servicing capacity, or living expenses being too high. Those banks' qualification criteria. A question from Villa. Apart from 80% LVRs, which aren't compulsory, mind you, it just definitely opens the scope of lending. What are the other factors that banks are looking at to release that equity? Is it purely rental income or future rental income from investments, tax benefits, and income sources?
Yeah, absolutely. Standard serviceability requirements, which is purely income coming in, be that from any of those sources Michael just mentioned, and expenses going out, living expenses, other loans, and any expenses that you've got going on personally.
Cool. I'll just clarify a point. There's some interesting commentary amongst our attendees here. Positive cash flow and positive gearing are two different things. So positive gearing is when the rent alone covers the holding costs. Positive cash flow is when the rent plus the tax benefits exceed the holding costs. So positive cash flow is what you want, because that means that the income sources exceed the outgoings. So guys, yeah, you can definitely have the best of both worlds. You can take advantage of negative gearing, be getting that tax back, but allowing the property to be positive cash flow at the same time. Thanks for all the feedback, ladies and gents. Glad it's been so useful for you. Matthew, I covered NIM, net interstate migration, as a quick recap. There are a lot of pieces to your question, Fahad. Sounds like it'd be well worth talking to one of our team and exploring all of that with regards to all those different points. The one thing that I will talk about to your last question, though, it's very relevant given today's climate. We are seeing minimal disruption to construction timeframes where our clients are in fact building. Reason for that is most of the builders hold reasonable supply chains of materials. The stuff that does have to come out from China, which is only about 10 to 20% of the material, is only held up by 2 to 3 weeks in terms of quarantine rules, they're telling us, and rental demand is still high. We had, one of our property management officers had 101 applications across 33 properties available for rent. So an indication of what I was talking about with regards to rental demand. Hey, Helen. Yes, I'm sure you will be able to get an access to the replay in the email that comes out post-webinar. Then a full recording will be available in that. Have you skipped forward to any questions that you want to answer, Amanda?
Just continuing to read through them. There's a question from Kajal. Apologies if that's mispronounced. It means if you live in an affluent suburb, you can borrow less. So the reality of that is probably yes. if you live in a suburb where they've determined that the average cost of living in that suburb is higher than someone who has exactly the same circumstances as you that lives in a slightly lesser economically wealthy suburb, then yes, the chances are that could make a difference. Whether that makes $100 difference a month or $1,000 difference a month has quite a few other factors involved. But yes, more affluent suburbs and postcodes can influence your borrowing power for sure.
Yeah, sure. Hey, Steve, yes, property flippers would probably be in a bit of bother, depending on where they are at. If they'd acquired a property 2 to 3 months ago and were looking to renovate it and potentially sell it, that would be problematic. Hence, part of the reason why we talk about property being long-term as a preferable strategy. And anyone that's got some job insecurity and in general has high holding costs across their portfolio will be more of a challenge. That's definitely more risky to have high holding costs that require a lot of income to be able to support that investment or that portfolio. So part of the reason why we don't advocate for older properties in blue chip areas, because they definitely fit that criteria.
Helen said, is it possible to speak with someone to discuss her situation and find out what she can qualify for? So yes, absolutely, Helen. Afterwards, fill in the form and all the details, send your information through, and we would love to be able to review that for you and see if we can assist.
Yeah, our team will reach out, Helen. Again, you can put yourself to the top of the pile by clicking on the review link or the strategy session link in the email that comes out afterwards. Good question from Jonathan around using, I guess, the line of credit to fund holding costs. Do you want to take that one? Do you want me to take it?
You can take it. Go for it.
Yeah, cool. So basically, for those that aren't aware, what Jonathan's talking about is where investors have substantial equity and basically a facility against that equity. If there's a negative holding cost to a property, you can effectively use that facility to cover that shortfall. Same rules apply if the holding cost is $50 a week and the facility is 50 grand. That 50,000 will last you a long time to see, again, long-term performance of property. If your facility is 10K and your holding cost is $500 a week, a lot more risky, I guess, with regards to exhausting that line of credit capacity. So, yeah, you definitely can use it. Obviously, the larger that facility and the longer term you're looking at, the better. Again, linked into to lower holding cost. Thanks, David. I'll learn. Like I said, I'm not the tech guy. I appreciate the heads up. The Zoom whiteboard I will check out for next time. Anything else around banks from the Royal Commission, Amanda?
Look, I mean, I think that's a bigger question. The Royal Commission really, I think the expression that was used, the banks got off like a slap on the wrist with a wet lettuce. There definitely was some implications and some things that are coming out of that. A lot of it's still being, I guess, researched and implemented. So something that we might see some more changes coming, definitely over the next 6 to 18 months. But yeah, bigger question, and probably don't have time to go into that right now.
Yeah, great question here from George with regards to, the high-end property. Yeah, definitely that higher end of the market, George, is the ones due to the fact that not everyone can afford, a $4 million purchase price in your example. That's what we saw through the GFC is the affordable end of the market was fairly robust. The 1 to kind of 1.5 mil was okay. 1.5 to 4 to 5 million got absolutely smashed. 5 million and above, everyone's too wealthy. They don't really care about what's happening and they can buy any property they want. So yeah, they're the different kind of segments of the market and why the more expensive property, yes, it grows rapidly when the markets are flying. It drops significantly when the markets are not. It's a lot more volatile as opposed to the affordable end that's a lot more consistent. Property. Oh, Angela, thanks. And I covered that in the previous explanation. On an interest-only loan, isn't that what we're talking about? It's cheaper now due to the yes, Sam, that's right.
A question here from Remy saying, do we think the banks will loosen their lending criteria in the near future to reactivate the housing market?
Good question.
So yeah, I mean, that again is a kind of crystal ball question. In terms of rates, you know, we don't really have much movement or room for movement there in terms of rates. In terms of the floor rates or the assessment rates that the banks use, again, they're already probably as low as they're going to get. The banks are currently using 2.5% on top of your actual interest rate. So somewhere in the low 5% assessment rates. So really, you know, the opportunity to loosen any lending criteria is probably more around some of the interest only lending or some of the criteria for investors and things that maybe have been implemented over the previous couple of years. Look, will it loosen up 2 months? It's not really anything that is kind of being discussed at the moment, but will all depend on what happens over the next 6 to 12 months and whether the banks are prepared to, you know, continue to open up lending if we need to stimulate the market and get some more money out there again.
Yeah, cool. We're going to take Helen's individual questions offline and talk about those with her individually. Positive cash flow and positive gearing reactive. I just covered that for you. That's a good question. How often can you refinance?
You could refinance very, very quickly if you wanted to. Look, in general, the banks like to see that you have a 6-month history of repayment on your current loan, just to prove that you are able to, you know, meet those repayments. There's no arrears or adverse credit history if they're taking on that debt. But you need to think about all the fees and charges involved in refinancing. So there are bank fees and charges. Generally, banks have got maybe $350 to discharge a loan. You've got some government fees and charges. So generally maybe $650 to $700 in fees to leave your current bank. You've got setup fees with a new bank. So it's not all just about the interest rate. You have to take a holistic approach and look at what you've already paid to set up the loan, what the potential, you know, fees and charges are going to be, and then really work out if there actually is an economic benefit to moving your loan that quickly. So sometimes it takes a couple of years for that to be a, you know, a realistic decision to make. Other times, absolutely, if you've had the loan for 6 months or more, it could be the right time to move. So reach out and we'll assess your individual situation and let you know what might be the right option for you.
Hence why the cashback is quite attractive in certain circumstances too.
Yeah, for sure.
Yeah. There's a good one there from Remy that's just come in. It'll be the last question that we take. Everyone, given we've gone well over time. Thanks for all of your input. Remy's question is, are there any lenders out there that will look at 1 year financials and tax returns for self-employed?
So that's probably a 2-part question. So there are definitely some non-bank or what we call non-prime lenders that will look at 1 year or even 6 months worth of being in business. The mainstream lenders do require that you've had an ABN registered for at least 2 years and then at least 1 full year's worth of financials or tax returns. So yes, there are 2 lenders who'll look at 1 year's tax return in isolation. Most other lenders want to see 2 years worth of financials and tax returns and to understand the difference between those. So Remy probably needs some clarification around that question as to what you're actually asking. But yes, absolutely, you can get lending with 1 year's worth of tax returns. Just depends on your situation as to whether that would fall into a normal mainstream lender or we'd be looking for a short-term solution with a non-mainstream bank.
And just a question from me on that, Amanda. I've never asked you this one. What if, say, a business owner's had a previous business for 3 or 4 years, for example, and then is working in a current new business and the new business ABN is less than 2 years old? Would their track record in business be sufficient for a bank?
Unfortunately not, because from a bank's perspective, they consider that to be an entirely different entity. So we do come across circumstances where sometimes accountants recommend a structure change. People could be going from a sole trader to a company or something like that. And so there are absolutely instances where, you know, depending on circumstances, that might be okay. But generally, if it's a brand new company, a brand new entity, doesn't matter what you were doing in your previous business, the bank's only concerned about current circumstances and what your current business is actually earning and making profit for you. Cool.
Excellent. Well, thanks everyone for joining us. A massive thank you to Amanda. Some awesome insights there. I've got a lot out of it. I hope everyone watching has got a lot out of it. Keep an eye on your inbox for the follow-up email from us. And thanks for joining us. We'll see you next time. Bye for now.